Hello, and welcome to my show, Searching for Integrity. My name really is John Smith, and I'm searching for people with integrity. Why? Because our country suffers from IDD, integrity deficit disorder. We have today, yours truly, me, will explore some economics, growth or not, mortgage rates for a home, better at the lot, stocks, Dow hits intraday, 2023, that was today in Dow Jones. And we have expectations about all of this, and I'm going to go into depth with this. We're going to have a look at probably how on a day on Thursday, like we're having here, tomorrow the market may not be what it is. That's often happened, and you have to be careful with that. Why? Because the Dow Jones was being pumped and pumped and pumped up to 300 points, which surprised me. And then I'm flipping over to look to see at the S&P, and the S&P is flat. It's got up 4 points. So something's happening going on, and then someone's going to take the fire alarm, I guess, and make it go off. It's a good thing, though, that we have people that are looking at the financials and the economics. And I picked up just some things that I could pass along to you. I'm looking here at a statement that coming up with the cold bullets of this next year, except for a couple of J.P. Morgan drop, next year to go back to Florida. That's absolutely shocking. A worst case scenario next year thesis research thing. We can go to 3,300. And right now we are at 3,600 in terms of the Dow Jones. Of course, that's based on a major recession. That is really, really scary stuff. I was talking 3,300. But I have to say, it's really hard to call a recession, particularly when it comes to the stock market. Stock market that way, to call the recession direct. Red line is 6 months before the recession began. So there's a difference. So the back part is not necessarily a harbinger of recessions per se. So it's really enough to get in there and understand what's going to happen if you try to get things on the market. The market loves money lower as the recession kicked off. Very good. Let's look and start with the economic backdrop. I think just looking at the house when it has reminded us still for us who wants to need and want a house. We really haven't seen that. We haven't seen a huge spike of layoffs. We still have no more job seekers. I think that's what's going to keep us out. And so even if we do see this sort of continued rippers out inflation, just sort of eats away wages, insulated spending a bit. And those that are one of those mortgage rates and interest rates go down. It'll keep us out of that recession, hopefully, if that can move the major rates, make them lower. Very good. Which is going to go through the whole thing kicked off. The estimate was a loss of $2 million jobs it does not look like that's going to happen at all. So, I mean, maybe Jay Powell will be able to brand about us offline. And so that we've got now is the factory of year long for a lot of what expects about how the bonds as low hanging fruit courts when the yields were 10% to look great. Everyone's given property. But now they look at a little better for folks looking at the budget like the trade really any place, and that is term treasuries over 20 years. U.S. economic growth has worked up 5.2% at an annual rate, and shrugging off higher interest rates, America's consumers spent enough to help drive the economy to a brisk 5.2% annual pace from July through September. Government reported Wednesday in an upgrade from its previous estimate. Government previously had estimated that the economy grew at a 4.9% annual rate the previous quarter. In the fourth quarter, though, economists say growth likely is slowly, sharply from the cumulative effects of higher borrowing rates on consumer and business spending. TD Economics, for example, expects growth in the October-December period to come in at 1.8% annual rate. Wednesday's second estimate of growth for the July-September quarter confirmed that the economy sharply accelerated from its 2.1% rate from April to June. It showed that the U.S. gross domestic product, the total output of goods and services, grew at its fastest quarterly rate in nearly 2 years. That's a big jump, and just a recent jump. It looked to me like things were going to turn the other direction, but that's not. And that's why I'm looking at this. The facts are pulling out now. Consumer spending, the lifeblood of the economy, rose at 3.6% between July and September. Still healthy, but downgrade from this previous estimate of 4%. Private investment surge at 10.5% annual pace, including a 6.2% increasing in housing investment, which defied higher mortgage rates. The economy also received a lift from companies being inventories in anticipation of future sales, which added 1.4 percentage points to quarterly growth. Also driving the third quarter growth was an uptick in spending and investment by government at all levels, federal, state, and local. U.S. economy, the world's largest, has proved resilient even as the Federal Reserve has raised its mark interest rate 11 times since March 22 to fight the worst bout of inflation in 4 decades. These higher interest rates have significantly increased consumer and business borrowing costs, but they also have eased inflationary pressures. Consumer prices rose 3.2% last month from 12 months earlier, a marked improvement from the 9.1% year-over-year inflation recorded in June 22. Well, this is interesting here. So the factual economics of what's doing with it and what you can maybe come to it if you're an economist. Let's see. Let's expand some more on the mortgage rates a little bit. That seems to be driving the train. And I believe that could be the case. And they're wondering, when will mortgage rates come down? Realtor.com is predicting buyers will start to see some relief in the new year. Home prices will drop next year, but so will inventory. The real estate site says it's in 2024 housing forecast. Mortgage rates are expected to fall for the rest of the year and into 2024. 30-year mortgage rate will fall below 7% below April 2024. Realtor.com says in its housing forecast for next year. The average mortgage rate in 2024 is expected to be 6.8%, and the 30-year may fall to as low as 6.5% by the end of the year. And that's going to give us a goal, and that's going to give us some hopes on which way the markets are going to go. Realtor.com sees mortgage rates falling to 6.5% by the end of 2024. We expected unemployment to begin gradually tick up, but we don't expect to see a huge surge and the labor market to begin to soften. But more importantly, we expect inflation to improve. The economy has begun showing indications of cooling off. In October, inflation was flat thanks to cheaper gasoline prices. The job market is also showing some signs of weakness, and the unemployment rate edged up that to a 21-month high of 3.9%. Mortgage rates have already begun to fall. They are no longer hovering at the 8% range, thanks to weaker economic data. 30-year mortgage was averaging 7.29%, according to Freddie Mac, one of the government lenders. But don't expect to see rates fall much lower, even though Realtor.com noted that the historical average for the 30-year mortgage rate between 2013 and 2019 was 4%. Home buyers should consider those days long gone. And I did. I was good on that and made some good calls of my own on interest rates. And of course, I was lucky enough to have the VA back me. I have had one at 3.5%. That's a big difference between that and 7.5%. Let's see what else we have. Home prices are projected to fall 1.7% in 2024. Those are the types of negotiating that you feel good about it, listening to your realtor, your broker, whoever you work with, and doing that. On the other hand, the data indicates a sharp slowdown in the home price growth out west. Home prices are expected to fall the most in 2024 in Austin and Round Rock, Texas, by 12.2%. That wasn't but 50 miles from New Braunfels, where I moved from. Now I'm in Arizona. It's been interesting, I can tell you, to get a good deal when we get it here, right? Good deal. Mortgage rates come down when they will. Hopefully, they'll have an impact on the rest of the economy. Today, the Dow hits the 2023 intraday high as stocks aimed to cap off best month in more than a year, says Joseph Adinolfi and Jamie Crisell. It's the end for the ETF devoted to meme stocks, which has fallen 6%, 60. The Dow Jones Industrial Average shot higher Thursday, hitting its highest intraday level of 2023. While the super and the S&P 500 and NASDAQ wavered between gains and losses as investors struggled to cap off a November to remember on a high note. How are stocks trading? Well, DJIA, that's the average of Dow Jones, gained 294 points to 35,721. It traded as high as 35,744. The S&P 500 SPX shed 6 points. Not much there at all. 45.45. The NASDAQ composite comp fell by 97 points. So not everybody is rolling along like the Dow Jones. There's others are showing you and indicating that they may not be by themselves. The Dow Jones will sit and look and saying, why is the S&P 500 doing this, and why is the NASDAQ doing what you're doing? And they'll have a pretty good answer. I would think they're preparing for the upgearing the numbers for 2024. The small cap focused Russell 2000 RUT risen more than 10% as the beaten down corner of the market came roaring back and is on track for its best month since January. What's driving markets? The Dow powered higher after the open on Thursday, driven by a more than 8% gain in Salesforce. Following a batch of strong quarterly earnings. At the same time, weakness in the other mega cap technology names such as NVIDIA, Meta Platforms, and others had a minus 3%. And Meta Platforms, which used to be Facebook, they're seeing the same downward for their stocks. Well, I think that the only thing I haven't covered on that one is oil futures. Everybody thought that oil was going to be going sky high. It's still sitting on 73 a barrel. Everybody was waiting, and nobody jumped on it. So there must be something that they don't know or that we don't know, which is usually the case, and that they do know. I looked at an article looking about staying defensive with lots of cash. It's a large mutual fund giant is cautious about markets in 2024. 5 investing insights. Stay defensive with lots of cash in your portfolio. Hey, hooray. That's my description of my own portfolio. Stay defensive with lots of cash. Wonderful. Love seeing. Number 2, bad commercial real estate loans won't blow up the economy. Refreshingly, T. Rowe Price rejects the concept of a house view. So not all its money managers and strategists are cautious across the board about the markets. Consider one portfolio manager's benign view on commercial real estate loan risk, an issue that continues to haunt investors. They worry here about the half-empty office buildings in major U.S. cities. Investors fret that lenders won't get paid back. Then damage with loan defaults will spread, creating a credit crisis that cripples a big part of the financial system. That's something to remember now. That's important. Recently, a deep dive on this topic part by meeting with several commercial real estate lenders. My thoughts going into this were those could be a disaster. This could spiral out of control, citing many banks' outsized exposure to commercial real estate loans. My conclusion is that the problem is small enough to be resolved within time or with time. It's an important thing. Bank regulators are going to be pouring that and looking at it, giving both eyes behind their palms, not knowing what's going to happen. Item number 3, invest in the U.S. infrastructure megatrend. Do you know the megatrend? Yes, reshoring is real. U.S. companies are moving supply chains back home to increase reliability. Federal policy could like this. Importantly, we are going to need that steel. One company, he believes, will benefit steel diamonds. Number 4, go with small caps. If you have to go somewhere, go with small caps. And that's the Russell 2000, the RUT. That's an index of small and mid-cap companies. I would say, look at that and study it and determine if that is available to you. Be especially careful now with companies that have a lot of debt. Companies did a great job of refinancing their debt at near zero interest rates in 2020 and 2021. But debt is not forever. It comes due and needs to be rolled over. That'll be the case soon for a lot of the cheap debt, arranging 2 to 3 years. 2024 and 2025, refinance risk comes due. The head of global investment grade, a lot of that low coupon debt from 2021, 2022 will need to be refinanced in 2024 and 2025. And this, of course, means that that's the case, is going to happen. This suggests that a debt default cycle is on the way. Debt default cycle, that's important because they have a big virtual zero now to 3.5%. The default cycle is one T. Rowe Capital Market Strategist is cautious about the U.S. economy in 2024. It also means that if you own stocks, you better understand the refinance risk of those big old commercial office buildings. Well, I would say that's we've covered what I looking at my clock, and I'm thinking, how did you get that way? I was enjoying what I was learning, and this is important. And I hope you made some notes. And I hope you tune in here to the YouTube, my channel. Let's go ahead and tell our listeners how to find me. I'm here right now in Arizona. Thank you listeners for tuning in to Searching for Integrity. And so long, and happy trails to all. Adios.